Hey folks, welcome back to another episode of Alamo Wealth Builders. I'm getting into the episode number 5 on the Think and Act Wealthy series. This episode is all about financial. So let's jump straight into it. Here's my contact info. If you guys ever need to look it up, here it is right here on this slide. Everything you need to know. So just go ahead and click on every single freaking one of those. You can get these off my website. So if you actually go to the top one, alamowealth.net, you can download this presentation to keep for yourself for free. So apologies for not being here in a week. I know if you guys have been following, I've missed a week. I was dead sick this past week. In fact, I'm still recovering. Got my prescribed medicine right here. Peanut butter whiskey. It's freaking great, by the way, if you guys ever try this stuff. Anyway, off topic. Last week we discussed mission statement and what it means to you. So our mission statement here is making a difference through education and commodities. So commodity is anything of value, basically. Knowing how to trade, how to exchange, barter, and build wealth doesn't just mean money, doesn't mean dollars. There's lots of different currency out in the world, and silver and gold and all that stuff. I mean, there was a day when you'd trade lambs. So commodities is what you need to understand is the underlying foundational value that you can create for something to trade for something else. And so knowing how to trade commodities, knowing what your commodities are, and knowing what the most valued commodities are in a certain region, a certain market, at a certain time, allows you to build that wealth. So riding the wave. The economy is a vast ocean, and money managers are surfers that ride the ebb and flow of the waters. Now, money managers doesn't mean like someone certified. You know, that's not what I'm talking about. Money managers could be you, could be me, could be anybody. Just whoever's managing that money and doing it in a professional manner. Legendary surfers learn to ride the wave young and live through the ups and downs. Learn from their mistakes and adapt to conquer tsunamis. So, after 2008, we saw a huge recession. Big recession, but just like in a wave, when you see a receding wave, that ocean's receding, what does that mean? Big waves coming. So if you're ready for it, you could ride that tsunami and blast off into success. So a lot of people did that when they were raising up after the recession back in 2000. I think about 2012, 2013 is when the economy started coming up. But 2014, 2015 is really where it started taking off. So if you got in at 2014, 2015, you really hit it at the right time. And if you're getting in it now, sorry, you're at the very top of the tsunami. You're the only way to go down from here is down. So, but that's not a problem. Not to worry. Getting in at any time and investing at any time is still a very good thing to do. You don't need to be in it when a huge recession just happened and now you've got cash flow and you can ride it. That's not necessity. You can get in right now, you can get in anytime. But just getting that huge wave is how you get really wealthy really fast. Financial. The one thing I always asked but could never truly find out in business education was the actuals. So, or a transparent look at the financials. So I call it actuals. I heard that from a mentor of mine decades ago. He said it's the actuals because it's the actuals and the factuals instead of the BS numbers or the gross numbers that everyone says. Like me, when I say if I got to tell you guys, hey, I did over $750,000 last year. Yeah, I mean, last year was my slow year, and I only did $750,000. Some of y'all are thinking, "What? This guy made almost $1 million in a slow year, and he wow, what an ego." Well, yeah, but what I'm not telling you is that's my gross. So after all expenses, after everything else, my net is the underlying. That's the actual that we want to get to, the bread and butter. What's the truth behind the numbers? And so when you're analyzing businesses, and especially when you're starting, it's really hard to find those numbers. It's really hard to get people to open their books to you. So I basically dumbed this down and simplified it at a high school level just so people getting into this I train a lot of people that are coming from different industries. I train people that are opening up restaurants. I train people that are looking to open up a moving companies, that are day traders, people that are wanting to get into stocks and actually just be a professional trader. I train people mostly 90% of my students are real estate. They've got get into real estate flipping, wholesaling, buy and holds while working a secondary job, whatever their case may be. All right, the breakdown. The bar. We will discuss a simplified profit and loss statement of a simple beer-only bar. Just keep it simple, just so you guys see the brick and mortar kind of P&L. The trader. We will show a simplified version of a typical trading day. Now, there's two types of traders. There's your standard day trader, and then you have your swing trader, which is a day trader is someone that basically sells everything. They walk out at the end of the trading day holding nothing. So a swing trader is someone that holds over to the next trading day or serve several days, and so typically for a day trader you're gonna mix a little bit of both in there, but we kind of just stick to one thing here. The flipper. This is my bread and butter. I've flipped over, honestly I lost count, dozens of properties. And I could tell you right now, they don't get any easier, and it's a lot of work. And the stuff that you see on HGTV is absolutely not the actuals. It is faktuals. Okay, so I'm going to show you kind of just a simplified version of the actuals, just so I don't lose you guys, but just so you'll see at the end of the road a typical flip and how much it really nets you after all expenses, if you're doing it right. And then the investor. So the investor is where everybody's trying to get to. So you have your four quadrants. If you haven't read that book from Robert Kiyosaki, the four cash flow quadrants, I believe it's what it's called, then you absolutely need to get that. Get it now. Get it. Stop what you're doing. Go get it. Audiobook, whatever. Listen to that book. Amazing. Change your life. The investor is where you can literally make money tax-free and just let it double every 5 years typically. I mean, that's the dream, right? So back in 2014 when the wave was coming up, when you were investing in apartments, if you were able to get in at that time, you were making 20% on your money. In fact, the S&P last year in 2019 did 19% return, which is almost 20%. So that did really well as well. So it's not just in apartments, but making that 20% annual is where everybody's trying to get to, because then every 5 years you're doubling your money. And that's because it's 20% times 5 years equals 100%. 20% times 5 equals 100. I know. I have to break that down because some people just won't get it. All right, the bar. If you are thinking about opening up a bar, stop. Don't do it. It's crazy. I've owned 3 bars. I've rescued. How many bars did I rescue? I've rescued probably 8 to 10 bars, and they all have the same underlying problem. So if you're going to go into a bar, you absolutely need to know what you're doing, have the right partners, have the right employees ready to help you out, know how to staff, know how to be accountable, know how to do your inventory check, know how to hire the right accountant to do your books, keep those books clean and clear, and stay on top of your stuff. It's a lot of work, a lot more than people think. They always get in the bar thinking, hey, I'll just own a bar, invite my friends over to have drinks, and we'll have fun, and I'll make money. No. If that's your idea, you will lose money. You'll lose very fast. But let's go ahead and get into it. Milestone chart for the typical startup phase. So January, meet with the city to discuss the plan. So you're always going to want to meet with the city officials. You don't want to just say, hey, I'm going to lease that place and start a bar, because typically the owner of that commercial complex might not know the laws. They just are leasing out. You know, there's a lot of lazy commercial owners out there. So you want to meet with the city, even if it's zoned properly. You want to meet with the city because, for instance, in Leon Valley, it was difficult for us to open up a bar in Leon Valley because Leon Valley did not want a bar. So it had to be a restaurant bar, and that for them to approve it. So you meet with the city, get it planned and discussed, and get it approved. And then after a couple months of approval and the designs and everything's ready to go, you now begin your lease. So you negotiate your allowance and you begin the remodel. Once your bar is finished, it shouldn't take more than a couple months to do that. But let's just say 3 months to be conservative. In June, your remodel is complete. Now you're marketing, you're pushing your PR. You've been doing this the whole time, but you're really hitting it up like, hey, this is the month before our hard open or our grand opening. So we need to really be pushing it, getting our name out there, lighting up the sky, getting everybody's interest. Being on the radio stations, getting on billboards, getting in everyone's Facebook media, everything, wherever you can get. And then you're going to have your equipment installed. Everything's ready to go, and you're going to do your soft checks. That means that you're actually just opening it up for your employees and your employees' friends and family. So you're soft opening, and you're just doing a dry run. So now it's like, okay, guys, come in, drink, order. Let's run through this like a regular day, and that way you can iron out all the kinks. Okay. So once you get that ironed out, you retrain your staff, redo it, retry it, retrain, keep doing it until you feel comfortable that you're ready to make this happen. Then you have your grand opening. Grand opening, all bets are off. As soon as those doors open, your staff better be ready, and just knock it out, stay on top of it, and from here on out, you're constantly pushing. It's a ride. It's a ride. And then, of course, in October, whenever you're planning, however you do your taxes, typically in October you'll start wrapping up your books, shoring up your accounts and records and stuff, and getting it ready for tax season. Okay, profit and loss statement on a bar. So typically you're going to be leasing it, $600 a month, depending, if you're a cheap little hole in the wall. You got your equipment rentals, you have your miscellaneous like internet, all that kind of stuff, insurance, your taxes, employee compensation, you got to pay your employees, and your goods, your COGS, your cost of goods sold. So if you had to buy those kegs to sell the beer, right? So that's the stuff you've got to buy. Equipment can also include the glassware and all that stuff that you get. Typically, if you're dealing with a supplier, they're going to actually give you free glasses and a lot of free stuff, signs and light up stuff for your bar. Typically, they're going to do that to help you out. And if you get a couple good suppliers, you could be pretty hooked up well with your equipment, getting ready. So if you notice there, the total is $5,950. Now your income, your beer sales were $6,600 for the month of October. Your events, you actually had 2 parties. One of them was a basketball party or whatever, a corporate event, and you were able to make $600 from privatizing those events. And then other, typically like you'll have like a close down, or maybe you'll have an advertisement for a company that wants to promote the local brewery that wants to promote their stuff at your bar. You'll actually charge them for the venue space. So you'll have a gross of $76.50. Your owner's draw. So typically on a sole proprietorship, small mom and pop shop like this, you're going to have an owner's draw, which is outside of salary because you're not a corporation, so you're not claiming salary, but you'll have an owner's draw. And so you're going to be making $1,500 a month, owning a small little bar. What'd you expect? And your net is $200. So your bar is profitable, and that's good. Don't worry about the $200. That $200, typically I would say put that in a stowaway, so you have cash on hand in case any damages happen. If a fight breaks out and they punch a hole in the wall, you've got money to repair your place. The trader. Typical day of a trader, then breakdown of month P&L. So I'm just going to go over a typical day. This is actually probably the hardest one to put together because it's not atypical. So at 7:30 a.m. NYSE opens. The trading opens. Okay, begin your trading analysis, your market options. So you're going to be identifying where you're going to be putting your trades. And then by 8:30, so within the hour, you've already got your stop losses set for the trade amount, and you've got your leverage. So let's say you've got 30 grand, because you need at least 25,000 to do your day trades, and that's total legal thing. Don't worry about it. But if you've got 30 grand in hand and you're ready to do your day, you can actually leverage up to 120 grand. If your stop loss is at 4 cents, then you can do 30,000 divided by 0.04, and that tells you how many shares you can do. Anyway, a lot of math, but we'll just get into that later. So make sure you get your stop losses in. You've got everything set, and now you're trading, or you're watching, you're moving, you're this is where you're hustling. And if you guys want to learn how to do that, there's tons of videos out there. I'm not going to show you because I'm not a day trader anymore. I tried it, lost one, stopped, cut my ties short, and that was not a game for me. So now by 10 o'clock, you're getting hungry, and you never want to trade on an empty stomach. So now you're figuring out, all right, so how's the day going? Am I going to be selling? Am I going to be swinging? So if at this point you're going to be knowing, okay, these are the trades I'm gonna be selling today. I'm done. Like, this is not I don't want to be holding any of this stuff overnight or over the week or whatever. So you're going to sell and be done with it. Then go to lunch. And when you come back, you're going to start trading again, checking your stuff, getting back out there, and then the trading closes. So that's a full day. Typically, if you're starting at 7:30, you're done by lunch. You don't go back in. You totally sell off by lunchtime. And at the end of the day, you go to the local bars. Go, and especially if you're in New York or somewhere like that, somewhere there's a financial district. You'll go to the local bars and rub shoulders with your fellow day traders, and you'll talk game and see where their losses and their wins were, and learn and grow. So here's a non-typical profit and loss statement for a day trader. So you've got your cash on hand, $30,000. That's your buying power of $120,000. Your stop loss, 1% of cash, so it's typically $300 per investment. So if your stop loss is at 4 cents, then your total shares is 300 divided by 4 cents equals 7,500 shares. So if you're winning 55, let's say you do 100 trades that day, you won 55 of them at a target of 6 cents, then you have a gain of 24,750. If you lost 45 of them, then your stop loss is at 4 cents, so you lost 13,500, which gives you a gross of 11,250. Now you do have commissions and fees you got to pay, so about $3,000 per month, and you're netting 8,250. And you've got capital gains on top of that, so you're making about $4,000 or $5,000. Now I have to say, this is a 10% game. This is not something that you can just get into and make it happen. I recommend you dabble a little bit. Play it like I did. I mean, the first time I got in, I lost, and then I thought I learned enough, so then I got back in, and I did. I won, but I didn't win great. So then I lost again because I got ahead of myself, and I learned again, and I adapted, and then I got back in, and I won. And I pretty much, over the amount of time that I put into it, I broke even. I basically paid for education. So I would recommend you not doing day trading. It is extremely volatile. The flipper. So your milestone chart for typical startup phases on flipping. So let's just say we start in January, start searching for a deal. Okay, and you're going around calling realtors, scrubbing online, you got your advertisements out there and people calling in or whatever. And so now you've got a deal that's come across and you locked it in. It's a deal you love, bread and butter, three bedroom, 2-bath house, brick, ranch style in a suburb that's very appeasable. So you close a deal, and it's typically ARV is times 0.7 minus the repairs. You buy your permits, get your plans, get your contractors, get started, and then market your strategy. So this is one thing a lot of people don't talk about, is from day one, you need to have your strategy set. And the reason for this is not only for your own goals, for your own planning, but also for taxes. Because if you say you start out, and right now I want to keep this house as a rental, it's a perfect rental, let's go ahead and keep it as a rental and plan all of our stuff to make it a rental, but then something happens. Maybe the market changes. Maybe you ran out of money. Maybe something on the back end you just need to sell so you can recover some of your debts, and get those paid credit cards that you maxed out and they're like interest charges crazy. Whatever your problem happened, you're trying to get that resolved. So you need to so you need to sell. So because you did that, you still have capital gains, but you started out advertising it. And from day one that you start advertising it, you now have tax implications. So let's say, for instance, I want to keep this and I want to rent it out. And from day one, I begin marketing it as a rental. Be prepared for this rental property in March. By the following year in March, I've owned it for 1 full year. Now I avoid those capital gains tax. Even if I sell it after a year, I get to avoid those 35, 37% capital gains tax because from day one, I was marketing it as a rental. Maybe something happened, something came up. But let's get back to it. So now in June, your complete remodel, you're finished. You list the property, market, get it pushed out there, and then within a month it's sold. You found a buyer, and it's closed, and you're happy, and you've made your money. And so now you're searching for another property, and then you found another property, and you close, and you repeat, and you keep this up. So in this model, this person's only doing 1 or 2 properties per year, and I'll show you why that's not a good thing. So your profit and loss statement on a flip typically looks like this. So you've got your property. You're going to be buying this thing at 75% of the value minus repairs. So the value of this property we looked at said it was $150,000. So we're picking it up at $75,000, which typically is what you do. You pick properties up at half cost. And so your closing costs, your inspector, city costs, title, survey, lender fees, things like that. So you've closed on it another $5,000. Then you've got your insurance, another grand. Taxes that are escrowed, $2,200. Like I said, you're planning to own it for the year, so our rate's 2.2, and so $2,200 on $100,000. The tax appraisal is typically lower than what the actual ARV is, but it's still higher than what you paid for it. Then you have what I call the oops, your out-of-pocket which is your permits, your fees, your contractors, your miscellaneous, your crap that you got to pay out of pocket and wait for that draw to come back. And by draw, I mean typically when you're getting a hard money on this, you've got that $45,000 that you budgeted for the flip, for the rehab. And if you bought this correctly at 70% of the ARV minus repairs, typically the lenders, hard money lenders, will lend up to 75%. So if your repair cost initially was 40 grand, well, now you can do 45,000 because you have that little bit of that buffer, which helps you in this case because you went over, which typically happens. And then you've got your utilities, another grand, and that's over time, of course, about 6 months. And then you've got your miscellaneous, your concessions, etc. So if you're paying for, let's say that they wanted to do a second survey or what they wanted concessions towards closing costs, that's typical. So another $1,000, and then you've got your listing. Your listing fee is going to be a flat rate if you use things like my favorite, which is Listing Spark. My friend Aaron Gistel, I think he did a fantastic job with the program. You get to list at $7 a day. I mean, it's just unbeatable. So you've got realtors out there if you want to waste money. I mean, spend a lot more money. Then you can spend 1 to 3% listing it with a realtor and have them do the work. So if you're new to this, I recommend maybe finding a realtor that's experienced, that is willing to do 1% and kind of teach you the ropes if you can do that. That way you have somebody to talk to and bounce things off of and learn the whole process. But after you've done 1 or 2, I recommend going to flat rate. And then you've got closing, again, title, lender fees, help, which is concessions and stuff, and etc. And so it's about $8 grand right there that just went out the window. Everybody's trying to get their hand in the pot to take your money. So total $137,600 expenses. Okay, your income. You sold the property. Congratulations, but you didn't sell it for $150,000 like you said or you thought you would. And actually, even though you thought you could get $150,000, you put it at $155,000 because I know how you do. and you couldn't sell it. So nobody was generating interest in that first week, so you dropped it down to 150. You started generating interest, but then they came back and said 149 is our offer. You accepted, and then you also had to pay them 1,000 concessions. So 149,000 was the property sale. But you were smart within that last 2 months, like that last month of the remodel and that month during your closing for the buyer. You were renting it out. You were doing short-term rentals. You had Airbnb in it or something, and you made $2,000. And so also maybe it was a downtown property in a great location that you could see the fireworks from the lake or something. And so you hosted an event. You did a Facebook event saying, "Hey, open house party, blah blah blah, $40 a ticket." And then you found 10 people to join, and they got to watch the fireworks, enjoy the spectacle, football game, whatever. And you also sold an event, so you made a little bit more money. So as an investor, this is how you need to be thinking. A lot of times on TV, they just show you, "Hey, we just paint and shiplap, and look how pretty we made it, and sell it, and we made money." No, a real investor is going to be thinking, "How can I squeeze every dollar I can get out of this thing? I need to make profit. I need to make this work." So every savvy idea you can think of, you need to get it on paper and see how you can implement it. So now we got gross $151,400. So your net is $13,800. Subtract those 35% taxes, and you're going to be walking away with $8,970. So $9,000 in your pocket after 5 months of work, 6 months of work. So you only made $9,000 in 6 months. That's, if you do that twice a year, that's $18,000 a year. There's people that work at McDonald's that make more than that. So to do all this work to only make $18,000 a year, you got to really think. Is this really the business for you? The way that people make money in this industry, and these are numbers that you could take to the bank. Yes, there's an occasional property to where I sold it for $450,000 because that market was in the rise, that neighborhood was in the rise, and I bought it for $200,000, and I only put $100,000 into it, and I had only $30,000 in fees and expenses, so I made $120,000, $130,000, $140,000 of pure profit. There are those, yes. Those are rare. These are typically what you're going to see. And that's the honest truth. And that's what nobody tells you on HGTV. That's what nobody tells you online, because they want you to get online and buy my book on how to become wealthy flipping real estate. And the real thing is yeah, you could. But you got to turn this into a business. You got to get professional with it. So you've got to be doing 10 to 20 of these a year for you to actually make the money that you want to make. So if you're doing 10 to 20 flips, let's just keep it easy. Let's say 10 flips. So you're doing about a flip a month. Then you're making your typical $9,000, $10,000 per flip average. And then you've got that one flip that made you 30, 40, 50 grand. So if you're thinking of it that way, then yes, you just made yourself $150,000 net profit per year flipping houses, because you're doing it like a business. But if you're just doing it casually, then great. There's nothing wrong with making another 18 grand. If you're a school teacher, you're making $50,000, $60,000 a year. Now you're making an extra 20. You're just making 70, 80. You're in a new tax bracket. Oops. You're in a new tax bracket now. So, you just got to be thinking about it, because maybe they get into that new tax bracket. Now you're taxed higher. So now is that smart? How does that work? And now you got to talk to your tax consultant and see how you can maximize your expenses, because a lot of times when you're in real estate, you get to write off a lot, and real estate is a fantastic tool for taking deductions and tax write-offs and things like that Uncle Sam throws you a bone. So maybe you'll make even more money by reducing your tax liability. Last but not least, the investor. So this is where everybody wants to get to. This is the big cojones, the big daddy. This is the big cheese. Like I said, on the 4 quadrants. If you're the investor, you're no tax liability, full profit, perfect madness. So you've flipped. Let's say you've been flipping for 10 years. And you've made a nice little nest egg. You sell a good chunk of your portfolio off, and you have $1 million in hand. that's in your a specific retirement account that you've built up over the years. So you've got $1 million in your retirement account, and now you're putting it out there. Let's just go over one deal that you'll be doing out of the 10 deals of putting 100 grand into 10 different deals. Okay. So in January, you begin your search as an accredited or sophisticated investor for private deals, because you cannot just go in and start giving money randomly. You've got to be accredited to get into a lot of these deals. Or sophisticated, which just means that you're educated, but you don't meet accredited standards, but you are educated and you're in a private group, and so you are now a friend of that group. If you're their friend, you have an established relationship, and you're educated, then you can invest in their deals if they are a specific SEC reg. But that's a topic for another Tuesday. So now it's March, and you've got your PPM, your private placement memorandum. You've read it over. You like it. 20% returns, right? Now you sign your K1s and you send it over, and you're ready to go. You're in the deal. So your deal sponsor then takes it and raises more money, and once they've got their money raised by June, they've closed on the property, and now they've begun their phase one of clean outs and their what I call crunch time. So this is where the hardest part of getting into a new MF is the first 3 months, where your evictions, your new tenant policies, new property management in place, contractors in and out, and just it's a total mess. But that's why you're just a passive investor, and you let the deal sponsor do all the work. So they do all the work, and about a month later, you're just following up. Hey, is your projection still aligned? Because typically within a month or two, they're going to know if their projections are aligned, or if they've kind of faded out because of contractor issues and tenants that didn't want to evict themselves when they were supposed to be evicted. So now you got to go through that whole legal process, which could put a pin in it. So let's say everything was going good, and so by October you should start receiving your dividends. Typically they're going to have what's called a moratorium, 90-day moratorium, which gives them 3 months to get things established, get tenants out, get some of the apartments rehabbed so they can get new tenants in and start bringing that NOI up. So they're basically bringing in income so they can start paying out their expenses and paying out their investors, and then they get their cut. So profit and loss, typically this is a balance sheet. It's actually not. I shouldn't have profit. I'm going to change that. Okay, balance sheet. So these are really simple. You basically had money in your retirement account at 100 grand. We had $1 million, but we're doing one of the 10 investments that you did this year. So I gave 100 grand. Within 5 years, that property was doing 20% return every year. I made 100 grand back into my retirement account. So now my retirement account at the end of 5 years has 200 grand in it. So if you had $1 million to start, 5 years later you have $2 million, and that's how you start doubling. And 2 million turns into 4 million, and then now at this market, 4 million would then turn into probably 6 million because we're not doubling anymore. But there's still some great deals out there. There's some deals that made 22% that I made this year, and there were some deals even on the S&P 500. Like I said earlier, did 19.4% return. I mean, that was a great year for my S&P. And so it still is out there, but you just have to do a little bit more grinding, a little bit more research, and just keep your money flowing in the right direction. And that'll wrap it up. So what's next? Now that you have seen the transparency on Untypical Financials, you need to make your team. And we're going to be discussing delegation on the next one. Thanks for watching, guys. Please subscribe, comment down in the section below, and let's have an open discussion about this if you have any questions. Also, click on the links, watch some other videos, get trained up on some stuff, and we'll see you on the next one.